Hey, Moon Platoon, Alexis Goldstein is going to have an AMA on Reddit tomorrow. I'll be covering that even if the markets are closed. Remember, Thursday is the last day of the market, and that means that not only are contracts expiring today if they had an expiry of tomorrow, but that means that we have 3 whole days to really sit down and think about what exactly is happening with the mixed squeeze. Is it still on? What is going on with Futu? Did that get margin called? That story is out, but one of the most important pieces that you need to understand is an article written by Alexis Goldstein herself about understanding visually what is total return swap and exactly what happened to Archegos Capital, right? This is going to be laying out the beginning of the end, the beginning of the margin call squeeze, and you guys do not want to miss it. So stick to the end, hit that like button early and often, and I'm going to be including Alexis Goldstein's newsletter so that you guys can subscribe and follow her because that's one of the greatest ways to support the people not only speaking up as a witness during the congressional hearing, but also going to give her valuable time for us to talk with on the AMA tomorrow. And I've been speaking to her on Reddit, so there might be a future something going on with us. So let's find out in the future of exactly what that means, but what happened with Archegos Capital is our first question. Last week, Viacom CBS lost half its value, but Viacom's woes turned into a $33 billion fire sale thanks to Archegos Capital, right? Total return swaps and leverage. Exactly what is this going to mean? With pretty pictures, you guys are going to understand thanks to Alexis. Last week, Viacom CBS positively tanked, losing half its value in more than a week. But Viacom's woes turned into a $33 billion market-wide asset liquidation event thanks to the holdings of a family fund, Archegos Capital, run by Sungkook Bill Hwang. Right, Bill Hwang, the nasty, wasty little person who was indicted by the SEC and barred from the market for close to a decade, now back and ruining more companies, ruining more financial markets. Hey, if you guys haven't seen that video yet about the Archegos event, I'll link that down below. And if I forget, remember to comment in this video and help me remind myself. It's the one where he is on the thumbnail. Why the troubles at Archegos led to market-wide fire sales is due to a combination of things. What Archegos was trading, derivatives that mimic stocks called total return swaps, and the leverage Archegos employed in doing these trades, who Archegos was trading with, a number of large banks, the lack of disclosures, many banks were on the same side of the same trade, which exacerbated the fire sale, but that fact appeared largely unknown till it all went bust. What was Archegos Capital doing? Well, reporting indicates that Archegos long positions were concentrated in about 8 names. Number 1, Viacom CBS. Number 2, Discovery, and both of these tanked big time. And unfortunately, this is Discovery A, and yesterday we were looking at Discovery B, which was up 80%, one of the biggest rips of the market that day. Tencent Music Entertainment Group, GSX and Baidu, a couple of other companies down the line. But Archegos wasn't buying stocks in these companies. Instead, perhaps in order to avoid the kinds of disclosures that are required when you hold a certain amount of stocks, Archegos used derivatives that mimic the performance of stocks but don't have the same disclosure requirements. One of the derivatives that they used was called a total return swap, right? Also known as an equity swap. What exactly is that? Well, we have a nice pretty picture to help you understand here from Ms. Goldstein. You can think of TRS as a financial product that provides nearly the same economic payoffs as a stock, but it isn't a stock. It's a swap. Swaps are financial instruments where 2 parties swap payments. You can read more about swaps here, but the here is not hyperlinked. In a total return swap, one party makes payments based on the return of an underlying reference asset. The other party makes payments based on a preset rate. This arrangement allows the receiving party to receive all the economic benefits of a reference asset, like stocks income and capital gains, without actually owning the asset. So here is that pretty picture right here, illustration of a hypothetical total return swap on Viacom between an investment bank and a private fund. So the private fund here is the picture on the left. They go ahead. Okay, I want to turn off my hover zoom so that I can actually turn off when I click the extension. Thank you. Nope, still works. So private fund sends credit risk, aka the risk of the counterparty going bust, over to the payer of total return. The payer total return gives the market risk, aka the risk of stock declining in price, over to the private fund over here, and they are the receiver of the total return, whereas the investment banker is the payer of the total return. In between, they are going to, investment bank is going to give Viacom CBS's dividends and capital gains over to the private fund, and the private fund gives over the fee to the investment bank. And finally, the investment bank brings into the reference asset for Viacom CBS. So essentially, this is just a swap of, I guess, risk and money both ways. And finally, this is like a stock. However, the swap itself is the asset. Why might you do this, you might ask? One might do it to try to avoid taxes of owning the stock outright. You might do it to gain access to a stock in a country that you have to live in to purchase, or you might do it, as it seems Archegos may have done, to avoid disclosing what you own to the public. Aw, sneaky Bill, back at it again. But this arrangement creates credit risks for the TRS payer, and that risk broke wide open last week for Archegos's counterparties, which included a number of major banks, and we covered that major banks before as well. Here it is, signing up here for premium access to all posts. Go ahead, I'm going to include this in the description. Remember that you want to support the sources, y'all. So I'm going to copy this, I'm going to post it in the description. Who was Archegos trading with? Archegos had what is called a prime broker relationship with a number of major banks, including Goldman Sachs, Morgan Stanley, and, oh look, Credit Suisse and Nomura. So both of those were part of our original story of margin called, or close to getting margin called, hedge funds as well. Sidebar, what is a prime broker? Large banks offer a number of bundled services to hedge funds and large private funds through an offering called prime brokerage. These services can include borrowing securities via securities lending, executing trades, including trades that use leverage, and cash management. If you like a concrete example, there's a PDF from Morgan Stanley marketing their prime brokerage offering. Viacom CBS started tanking, leading to a margin call. Reporting has shown that Archegos held total return swaps on the 8 stocks listed above with all of its prime brokers. In order to manage their risk, the banks demand collateral to demonstrate that Archegos wouldn't go under should their trade move against them. When Viacom CBS shares started tanking, one or more of Archegos' prime brokers hit them with a margin call, which they couldn't meet, right? And if you can't meet it, default. The sidebar. What is a margin call? When a position begins to move against you, right, either a short or a long position, your broker will typically demand that you deposit additional money or assets into your account, enough that the value of your account reaches a certain value known as the maintenance margin. That is a margin call. In simple ape terms, if you can no longer afford the thing that you have an obligation to pay back because you're either buying on credit or selling on credit, this is the time that you are going to have to put more money in, which likely means sell stocks, because we are all here in the stock market here. And selling stocks is on the long side to get more money. Selling stocks on the short side also is the key to then turning that around and buying the stock that you are short. So that is one of the only ways to be able to do a margin call here. The $33 billion fire sale. When Archegos failed to meet its margin call, the banks with trading relationships with Archegos needed to begin to unwind the massive positions. But since they all needed to sell shares of the same 8 stocks, there was no way to do it without moving the market. And move the market they did. Here's the daily charts of just 4 of the stocks, Baidu, Viacom, TME, and GSX, that Archegos had derivative positions in over the last week. Boom, look at that parallel. This is just like a simple explanation right there. Archegos counterparties, once they had a handle on what was happening, actually met to try and figure out how they could all offload giant blocks of the same stocks in a way that could disrupt the market the least. The Financial Times reported, before the troubles of the family office burst into public view at the end of the week, representatives from the trading partners Goldman Sachs, Morgan Stanley, Credit Suisse, UBS, and Nomura held a meeting with Archegos to discuss an orderly wind down of troubled trades. But it seems Morgan Stanley and Goldman Sachs moved first, perhaps trying to sell before the other banks did, and stem their losses as the market began to move against the names they all needed to offload. Oh, sneaky Morgan Stanley and Goldman Sachs. There's a lot of sneaky betraying, backstabbing here. It's basically a big game of Among Us Now we're topical, right? It was like a game of chicken, one person said. By Friday morning, any hopes of coordination had been snuffed out, and the floodgates opened when Goldman began pitching global investors on billions of dollars of Archegos-linked stocks. Morgan Stanley joined hours later, and the two sold roughly $19 billion in big block trades that day alone, according to the People. Further from the FT, people familiar with the talks said Goldman Sachs, which was very exposed to Archegos, listened to the discussions but did not commit to an agreement on Thursday evening. On Friday morning, the bank pitched a $3.6 billion block sale that was quickly increased to $6.6 billion. By the end of the day, the bank had liquidated some $10.5 billion of securities linked to Archegos, according to the people briefed on the matter. Morgan Stanley has also sold more than $10 billion worth of stock tied to Archegos, including roughly $8 billion it marketed in big block trades on Friday. So why were so many prime brokers doing business with someone banned from Hong Kong's trading markets, right? Speaking of Hong Kong, we are going to continue covering this story with Futu, another possible margin call, right? So far, that story is not complete yet, so that's why this is a relevant right now margin call mixed squeeze. Is that coming right earlier than we thought it was going to? Prior to launching Archegos, Huang pled guilty to wire fraud charges in 2012, paid $44 million to settle insider trading charges with the SEC that same year. This is what we mentioned earlier. 2 years later, he was banned from trading in Hong Kong markets for 4 years after admitting to using inside information to trade Chinese bank stocks. It's kind of like, you know, when you shoplift and then you steal millions of dollars and then you have to pay back millions of dollars, and then you go shoplift again and you steal billions of dollars, you know, you get banned for 4 years from that convenience store for sure. Just trying to tell you, this is the kind of white-collar crime that and its punishment, size in relation. Reporting shows that Huang managed up to $10 billion of the Huang family's wealth at Archegos. Archegos prime brokers allowed the firm to borrow and hold assets many multiples its total size. Since extending total return swaps to a counterparty carries credit risk with it, it seems likely that Credit Suisse and Nomura are regretting their dealings with Archegos, as they've both been hit with heavy losses as they unwound their positions with the fund. Credit Suisse has yet to confirm its losses, but the sources said that Swiss Bank faces up to $4 billion in losses. Nomura, Japan's largest investment bank, warned on Monday of a possible $2 billion in losses. And this is from our original story as well. Bank stocks have been taking a hit across the board this week, despite Goldman and Morgan Stanley trying to reassure the markets that they got out in time. Wow, those sneaky sneakies. Those sneaky sneaks are like, yeah, we weren't so dumb to... However, Credit Suisse, Goldman Sachs, Morgan Stanley, and Nomura are largely down in the last week, right? They just couldn't get out in time of the shrapnel hitting the fan. What can the SEC do to improve transparency? Welcome to the learning part of the show. While Archegos Capital is not a hedge fund, their use of total return swaps to avoid reporting stock trades on the Form 13F is a technique also utilized by certain hedge funds in order to avoid the disclosures. The SEC could act to address this by expanding the range of financial products disclosed by Form 13F. This would help regulators and the broader public have a better window into the activities of hedge funds. The SEC could change the reporting on Form 13F to include short stock positions, short option positions, right, total return swaps, and other equity derivatives that mimic the behavior and payouts of stocks. Is there a role for Congress, right, in Archegos? Another issue highlighted by the Archegos situation is the carve out the family funds enjoy from registering under the Investment Advisors Act of 1940. The Dodd-Frank Wall Street Reform and Consumer Protection Act exempted family offices managing solely their own finances this requirement. Congress, together with the regulators, may want to examine this exemption for family funds like Archegos are creating regulatory blind spots that contribute to systemic risk. And regulatory blind spots is likely just the name of the family crest at this rate, because he has not only been caught once and then twice by multiple different governments, but now this time it's likely that this is not going to be the last time again. So if this video showed you a little bit about how to start a $10 billion family business and create that into a hedge fund, this is one of the best ways to do it. But all in seriousness, if this is the first step into you learning about these swaps and how exactly are they, different in terms of risks and regulations versus stocks, or at the very least, this is the first time that you have heard of the mixed squeeze, the margin call squeeze, and how it affects AMC and GME, you should definitely drop a comment down below, ask me a couple of questions, and specifically drop a subscribe, because we are just 250 subs away from 75,000 and we're on our way to 100K. We would love to bring you aboard. Thank you guys for those of you who have already pressed that join button or gone over to Patreon and helped support the show there, and we will see all of you in the money.